Hello, traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we're going to break down one of the most important aspects of technical analysis. We're going to be talking about reversal patterns. These patterns can signal a significant shift in market direction, giving you the opportunity to enter trades at the perfect moment before the trend changes. So, whether you're looking at a potential bullish reversal or a bearish one, understanding these formations will give you a powerful edge in your trading strategy. Stick around until the end and you will learn how to identify these reversal patterns on your charts, when to enter and exit trades, and how to manage your risk effectively. So let's get started. So let's talk about key reversal patterns. Reversal patterns are vital for identifying potential trend changes in the market, and they signal when a prevailing trend is losing momentum and the reversal is likely. And this allows you to position yourself accordingly. Let's get over some of the most important reversal patterns and how they can be used to make informed trading decisions. First, we'll be talking about the head and shoulders pattern. This is the head and shoulders pattern that you're seeing right here on the charts. I'll just use the path tool to demonstrate how it should look like on the charts. So the head and shoulders pattern is one of the most reliable indicators of a bearish reversal. It forms after an uptrend and consists of three peaks: the left shoulder, the head, and the right shoulder. The middle peak, the head, is higher than the two shoulders, indicating that buyers are losing strength. The left shoulder rises to a peak and then pulls back, as you can see. The head rises again. The head just shows that price rises again, forming a higher peak, followed by another decline. Now the right shoulder shows that price rises once more but forms a lower peak than the head, signaling weakening momentum. The key element in this pattern is the neckline, which is this. Sometimes it could be lower than it a little bit or higher than it, but it shouldn't be far from it. So the neckline connects the lows between the shoulders. A break below this neckline confirms that a bearish reversal is likely. Sometimes we may have a pullback to retest the neckline before the further drops. So this is one way to look for the head and shoulders pattern. So let's hop on the charts and look for this pattern. We have one right here. So we were bullish, we've been bullish, and we have one situated right here. Have price rising, giving us the left shoulder, a pullback, minor pullback. The head price rose slightly higher than the left shoulder. Here we have the head, then we have the pullback, and then we have the right shoulder, and then we have the break of the neckline right here. Have the pullback into, remember I talked about the pullback into the neckline break, and continuation of the head and shoulders pattern. So this is exactly how it looks, and traders should be looking to trade once the neckline, which is this area right here, once the neckline is broken, traders should be looking to enter trades right here. So you may adjust it to the wicks, or you may just use the key levels. So if you're using the wicks, you have the pullback and the retest of that neckline and further sells. So let's look at one more example of the head and shoulders pattern that does justice to it. You can see this one. So this is the left shoulder, the head, have this, and the right shoulder right here, and further sells. Remember, the break of the neckline shows further sells. We may have a pullback into the zone, the range, to retest the neckline break and further sells. So this is another example of the head and shoulders pattern. So this is the neckline right here. You can see price reacting off of this neckline, coming back for the retest. Also, I think I skipped one example of the head and shoulder. We have one classic example here, but it is much bigger. We have the okay, I didn't really see it clearly. Okay, this is the Quasimodo. I'm going to talk about it in subsequent sections. Next, let's talk about the double top and double bottom reversal patterns. So the double top and double bottom patterns are classic reversal formations that occur after strong trends. These patterns these patterns indicate that the market has tested a key level twice but failed to break through, signaling that a reversal could be imminent. Now, for the double top, the pattern forms after an uptrend when the price reaches a high point twice but fails to break above it. The two peaks are roughly equal in height, and once the price breaks below the support level between them, it forms a bearish reversal. This is the support level between them, this right here. Once price breaks below this level of the double top, it shows we should be looking for a bearish reversal. Sometimes price could come back and retest this support or the neckline, which now uses it as resistance. The support now turns resistance, and we have a drop from that area, which is the bearish reversal completed. So let's look at some examples. Let's look at this example. We have one example looking at us already. We have price pushing here, we have the support, we have another push to the upside, then we have the break of this support. This is the classic double top double top pattern, and we have the retest of this support. Now, it's not every time we get the retest, but when you have a retest like this, it shows a very valid double top pattern. I should be looking for a continuation from that level. As you can see right here, we have this wonderful retest of that double top pattern. So let's look at the double bottom pattern, the double bottom reversal pattern. So this is it right here. It's just the opposite of the double top. So for the double bottom, the pattern occurs after a downtrend when the price hits a low point twice but fails to break lower. The two troughs are roughly equal in weight, in depth, and once the price breaks above the resistance level between them, it confirms a bullish reversal. So we have an example here where price give us this push to the downside. We have the resistance between them, have another drop in this zone close to the first bottom, have another drop close to it, and we have the break of resistance, the push to the upside. Sometimes price likes to come to retest this area, which in this case it did. You can see price retesting this area and the push to continue the trend to the upside. Now this is used as a reversal pattern. You can see this is a classic retest of this zone, a classic retest of that resistance zone. The resistance zone was now used as support to push price upwards. The next on my list is the Quasimodo pattern. The Quasimodo pattern is a common reversal pattern, and it can offer excellent trading opportunities when correctly identified. It resembles an irregular head and shoulder, but with an extended right shoulder. So this is the Quasimodo pattern. So this unique structure often signals strong reversals after impulsive market moves. So let's talk about the formation. The Quasimodo pattern starts with an impulsive move in one direction, followed by a retracement that creates what looks like a head and shoulders formation. However, unlike traditional head and shoulders, this one features an extended right shoulder that moves further than expected before reversing. Now, this extended right shoulder provides additional confirmation of weakening momentum in the current trend. So this is the Quasimodo pattern right here. Now, looking at the charts, we see one staring at us. So we had price give us this push to the downside. Then we had the drop, and we had the break of this resistance here.
Then we have the extended right shoulder pulling back into this support level. This is the Quasimodo pattern. And then we have the push to the upside. Our price is expected to come back to the support zone right here and give us a push to the upside. So this is how the Quasimodo pattern looks like. It's a very common and popular pattern used in the market. So for a bearish example, we have one here. Remember, we talked about it earlier. I said I was going to show you. So this is it right here. We have the first push, the pullback, the next push, then we have the massive pullback. And this is the extended right shoulder I talked about. Now, price is expected to pull back to this resistance level before giving us the push to the downside. So this is the Quasimodo pattern. As you can see, it's clear here. Price is expected to come back to this resistance and give us a push to the downside. So let's look at one more example of the Quasimodo pattern before we call it a day. You can see this one right here. These are just reversal patterns that signifies that the market is about to reverse to the upside or to the downside, depending on the market context when you saw the pattern. As you can see, this is the support level that price is expected to pull back to, and price did just that, pull back to this level and give us a push to the upside. If you're looking to continue and mitigate this other block, you can just proceed, and this is a bullish trend, so just keep going. If you're a trend line trader, you can see the trend line formation. So all of these are just ways to show that whatever bearish move that was happening right here, it's time for a reversal, and we should be looking for a push to the upside instead of a continuation of this bearish trend. So let's talk about risk management. No strategy is complete without proper risk management. Always ensure that your potential reward is greater than your risk. Ideally aiming for at least a 1:2 risk to reward ratio means if you're risking 50 pips on a trade, you should aim for at least 100 pips. So never risk more than 1 to 2% of your account on any single trade. Adjust position sizes according to your stop loss distance so that you are not overexposed in volatile markets. So by combining these elements, entry rules, stop loss placements, target settings, and risk management, you will be able to execute trades based on reversal patterns with confidence and discipline. Alright traders, we've come to the end of today's video. If you found this video helpful, don't forget to like the video, subscribe to the channel, and turn on the notification bell so you never miss out on future content. Keep practicing, stay disciplined, and happy trading.